Hello and welcome, dear investor. My name is Thorsten Tiet. I'm the founder of Dividend Stocks Cash. This is a stock screener dedicated to find high quality stocks. If you invest in high quality stocks and if you keep these stocks of companies which increase their earnings mostly stable over the years, and if you buy these stocks and if you keep these stocks, then you will profit from capital gains and growing dividends as well. And this is the most important aspect of successful investing, and of second importance is the purchase price, because the purchase price determines your overall yield. And this video is not about how you find high quality stocks, but about how you evaluate the stock price of high quality stocks. And first I show you the importance for your overall yield of the purchase price, and second I show you some basics of the valuation, how to get an idea about the valuation of a stock, mostly with a little bit practice, even within seconds, not within minutes, but within seconds even. So let's start. I wanted to choose Unilever as a first example. It's a dividend aristocrat in the food industry outside the United States. And then you see here the valuation tab, and get rid of this. We have the stock price of the last 20 years here, and you see that we had a period of stagnation followed by a period of success. And what I want to show you now is the importance of the purchase price for your yield. Assuming that you bought the price, that you bought Unilever for 1,000 euro here at the end of the year 2007 till today, then you had an overall yield of about 130%, dividends included without taxation, and this corresponds to an annual yield of 7%. That's already not bad. It's about in line overall with the general stock market. But if you bought the stock some months later, 3 months later, then you see that the yield becomes much higher. Annual yield increases from 7% to nearly 30%, and the total yield is even 284%. So that's much higher than if you bought the stock 3 months earlier. Now you might know that this is the financial crisis here. So this is a stock market crash, and of course also Unilever suffered heavily from the stock market crash on the one hand. So, and that's not no one has foreseen something like that. Stock market crash always comes as a surprise, otherwise it wouldn't be a stock market crash. So on the one hand, no one was able to catch this point here as to make the purchase here. On the other hand, I will show you that Unilever already was overvalued in this period, and if you had done a valuation, you might not have bought Unilever at this stock price. So let's make a valuation, and I use the adjusted earnings here, and we can do the valuation simply by choosing this period here till there, for example, or even just till there, because that was our decision point. That was the presence. We go back into the time machine, and that's now the presence, and then the fair value is below 20 euro, but the stock price is already above 25 euro. And if you now have to decide if you buy the stock or not, you might be tempted to say, no, I think the stock is overvalued, I won't buy it right now. So you wait a little bit, and then the stock market crashes, or there are already bad signs about the stock market, and then you might buy the stock, for example here, about where the fair value is in range about 20 euro. So you buy the stock here, and then you already have the first half of the stock market crash avoided. And if you buy the stock here, or if you bought the stock here till today, then you have an overall yield of 9.5%. That's not 7%, but already 9.5%. So already well above if you bought the stock here at the cost of 25 euro. And no one is able to catch the absolute lows, but that's not even necessary. If you just respect the fair value, then you already bought here, and that's much better if you bought the stock here. So that's the point, that's the importance of the purchase price, and it makes sense for high quality stocks with stable earnings. How do you detect high quality stocks? You just look at the earnings, at the cash flows, and if they increase stably, how do you say this? If they increase in a reliable manner, then it's a high quality stock. If profits, earnings, cash flows don't increase, but if they do, if they zigzag, or if they even decrease, then you don't have a high quality stock. It's really that simple. You can use the charts, and you have metrics, ability metrics, compounded annual growth rates, helping you to find these stocks already by screening, so that you don't need to go from stock to stock and watch the charts, even if that makes fun, as people told me, but it's time consuming. It would be a very time consuming process to do so. So second point now is how to make use, or how to evaluate a stock, if the stock is cheap or not. And here I think let's take some examples. Let's stay with Unilever. Why not? So we had evaluated the period here. We had evaluated the fair values of the past, but the past might be interesting for learning purposes, but not for real decision making. For decision making, the presence is of most importance. And now you see the stock here, or no, you don't see the stock, but you see the most important fundamentals. We also have the dividends, and then we have all these multiples, including the dividend yields. And if we want to get an idea about the valuation, the current valuation of the stock, then we do so by choosing the characteristic time period of earnings, cash flows, dividends for the present company. And we have here Unilever as a rather stable stock. They now have, for example, price earnings of 25, which is higher than it was in the past, with the exceptions of 2001 and 2002. But we see it's also still an expensive evaluation, but only if you look at the non-adjusted earnings. If you look at the adjusted earnings, then you see that the current valuation of 20 is not so high. It was even higher already in 2015. That's a very interesting point. Maybe I should try to give you an idea about what's the difference between the reported earnings and the adjusted earnings. And we can do so looking, for example, at the workstation of FactSet. FactSet is the main data provider of dividend stocks cash. And I have Microsoft here right now, not Unilever, Microsoft. Microsoft is a better example to illustrate the difference between reported earnings and adjusted earnings. You see here the reported earnings. It's the US GAAP, which is applied to the to Microsoft. IFRS, for example, for many German stocks, probably also for Unilever. And you see that we have the reported earnings per share here and the adjusted earnings here and also here, excluding stock option exercises. This is this one. So we have two levels, if you want so, of adjusted earnings. And everything here between is kind of, it's an adjustment. And you see that mostly they are not red, these adjustments, but they are blue or black, which means that the adjustments increase the earnings. And if they are in red, they decrease the earnings. So mostly the adjusted earnings are higher than the reported earnings. In the case of Microsoft, sometimes even nearly double as high as the reported earnings. Why? We have the restructuring costs, we have changes in the license model on the Windows operating system, which deferred revenues, for example. We have the Trump tax decrease act, whatever the correct name, here it is. And there were some repatriation fees or taxes the companies had to pay to bring back the money they earned, which was still abroad. And these are all kind of adjustments, making the adjusted earnings higher than the reported earnings. And on dividend stocks cash, we have this one, we have the reported earnings, and we have this one, the adjusted earnings. So we also, these stock-based compensations, we also include them into the adjustments. And that's most, and you also see here for Unilever that the adjusted earnings, they run much smoother. Adjusted earnings mostly are smoother than the reported earnings because the one-time costs mostly are excluded, and that makes it even better, or the fair value calculation profits from this smoothing of the earnings. Okay, then we are still in the progress of finding the right valuation period for Unilever. And I said that regarding the reported earnings, Unilever is very well, or looks expensive, but regarding the adjusted earnings, Unilever looks about fairly priced just by comparing the price earnings here. And I'd say that a nice period or a representative period could be this one, starting from here. And now we include the stock price in this chart. And next we include the calculated fair values, first based on the reported earnings. And here we will see that the Unilever is just fairly priced now. It would be fairly priced, but if you make the fair value based on the adjusted earnings, then you see that the stock looks undervalued. I will zoom in and remove all this here, the metrics per share, and then you see it much better that the current value of the stock according to fair value calculation based on adjusted earnings is €50, about €50, which is much higher than the €44.30 the stock market, the stock costs right now. We also have metrics of fair values according to operating cash flow, which is here, and even according to the dividends, according to the current dividend yield. And here you see that the fair value is even €52 high. So it's a clear undervaluation according to the current dividend yield, because the current dividend yield is much higher than it was in the past. In the past, current dividend yield was 3.1%, and now the current dividend yield is, I will show you, the current dividend yield is 3.7%, so much higher than in the past. We looked at, I think, about this period here, and then you'll see that this dividend yield is right above the average dividend yield here in this during these years. So that's how you evaluate a stock, and you can do the same for each stock, and which is also important. Or I will show you another stock which might be important to you, for example, or it might be interesting for you. For example, Altria. Tobacco is a little bit out of fashion right now, and especially for Altria, the reported earnings make no sense because there was how do you say in English? They bought Juul in 2019. They bought a share on Juul, and they made amortization. I don't know if it's the correct word, but they made a write-off. I think that's the correct word. They made a write-off over several billion US dollar, and the result was a loss. So we have not earnings, but we have a loss here for Altria. And of course, if you try to get the fair value based on these metrics, the result is that fair value, the share price is null because they have losses. So the share is worth nothing according to this, which is not right. If you look at the adjusted earnings, then you see that this write-off was discarded. It was adjusted. You also see that the earnings here are much smoother than the earnings, the reported earnings. So the adjusted earnings are smoother once more. And especially here, we also have the operating cash flow, which is a little bit even more bumpy than the reported earnings. And then we have the dividends, and it's a very nice picture here. They even increased their dividends here in 2017, 2018. Okay, so we have the stock price, and now we want to have the valuation, the fair value, or first the valuation period. We want to find this one. And right now for 11, 12, I take a look at the adjusted earnings here, and then I would start this time frame, because here we had price earnings till nearly 19, which is much higher than right now. And here it also price earnings adjusted about 20. Okay, let's stay with this period. Honestly, I don't think it makes a very big difference. You always see here the average multiples. Right now we have P adjusted 40.5. If I enlarge the period, we have 30.8, even a little bit lower, because tobacco is out of fashion and nobody really knows about the success of the next generation products. This might be an even better indication, a little bit more careful one. Okay, fair value based on reported earnings looks like that. And here you see that extreme overvaluation in this period, and now fair value not useful anymore in the presence. And then according to the analysts' estimates, then we have a clear undervaluation. The stock price is $37 US, $38 US about, and the fair value according to the estimates is 60 for the current business year, for the running business year. So it's a clear undervaluation here. And is it the same if we add the fair value based on adjusted earnings? Then you see this here, and then you see that the fair value first runs much smoother than the fair value based on the reported earnings, and it's also more close to the stock price. And we see this overvaluation here. There, the stock was still fair valued starting in 2014, and then we had period of overvaluation. I zoom in a little bit, and then here we have the phase of correction, and then even undervaluation according to this fair value. Then we have the fair value based on operating cash flows, because operating cash flows are bumpy. You see it here. The fair value is bumpy as well. I exclude it. I exclude also the fair value based on reported earnings, because I think that the fair value based on reported earnings is much better. And what is also interesting is that according to the analyst estimates, reported earnings and adjusted earnings will be the same, which is also very often the case, because these one-time adjustments, as you see them here, Microsoft, they are not known for the future. It's also the case in the future for the future estimates for Microsoft. Nobody knows the adjustments the company will do, and that's why mostly reported earnings for the estimates and adjusted earnings are very close to each other. So they don't match exactly, but they are very close to each other for the future. And we get rid of these fair value based on reported earnings. We add the fair value based on dividends, which is important because for Altria is a classic dividend stock, nice dividend stock. So for especially for dividend income investors. And then you see that the fair value based on reported earnings, on adjusted earnings, and the fair value based on dividends is nearly identical. That's very interesting. I don't think this is coincidence. I rather think that the management might use something like the adjusted earnings as well to decide about the level or the increase of the dividends. And this is why also the fair values, these both fair values are nearly identical. And from this point of view, Altria seems to be clearly undervalued. And now, if you want to get an idea about the short-term upside potential, you can do so by combining the current stock price here on the presence with a point in future according to what you believe could be a realistic price in the future. According to the adjusted estimates, it would be nearly $70, which makes a total yield of more than 100% within about 2.5 years, or 33% yearly on a yearly basis. It's very, it looks very attractive here. You can also be a little bit more careful about the half of it, and you have still an annual yield of 20%. This is not a stock recommendation of Altria. It's just a technical presentation of how to get an idea of the current valuation, and this about the short-term prospect to make an additional profit if you buy the stock right now, because it seems to be undervalued. Of course, this annual yield of 20% is nothing you can you can expect in the long run, but it's just because the stock seems to be clearly undervalued right now. Okay, this is the that's it. I try to give you an idea about how to evaluate or get an idea of the fair value of quality stocks. I showed you the difference about the adjusted and the reported earnings, what's in between, why the reported adjusted earnings are a little bit smoother and in general more useful, or they favor the fair value calculation approach. And here it was also very interesting. I wasn't aware before we made this video that the fair value dividends and the fair value based on adjusted earnings very closely match, because I think that the adjusted earnings are also a measurement for the management to make some decisions like the increase of the dividends, here in this case of Altria. Okay, thanks for watching. I hope that was interesting. And then good luck finding high quality stocks and profit from capital gains and growing dividends. Bye bye.